Hi, and welcome to Street Smart Options. Thanks for watching. Tonight, we're going to be talking about options trading tips and tricks. So, I'm Jim Bunker, and with me is Jonathan Sherman. And as I said, tonight we're going to talk about options trading tips and tricks. So, folks, if you're not a subscriber on our YouTube channel, please give some thought to that. By subscribing, all you have to do is hit the subscription button, and then you might want to hit the bell icon as well so you don't miss other great videos like this where we talk about things like options trading tips and tricks. Jonathan, go ahead.
Yeah, so maybe the first thing to think about is I'll just go one by one. That'd probably be the easiest thing to do. And let's start with some tips. I think that maybe the first thing to think about is, control your risk. Tip number one, control your risk. So don't put too much risk on per trade. In fact, you should only really expose about 2% of your portfolio to loss at a time. That doesn't mean like if you have $100,000 portfolio, you only trade $2,000. It means that your trade, your likely potential for loss should only be $2,000. So you could put on a trade that's bigger than that, and then use a stop loss and get out. And then you're still adhering to your rules of taking 2% risk. So maybe that's the first thing. And a lot of beginners make that mistake. They put too much risk on, and then they blow out their account pretty quick because they're maybe risking 10% of their account at the time. And of course, it gets harder when you have a smaller account, and you do have to risk more when you have a smaller account. But then you also got to maybe stay with safer trades, right? And so that'd be another tip, is that if you have a small account, you don't want to be doing a whole lot of high risk trades. You want to be doing safer trades until you build your account up, and then you can start controlling your risk a little bit easier. The other tip is, don't have too much exposure to time value, to time wasting value. You can put on trades that benefit, that make a profit from the wasting time value of an option. But what you don't want to do is end up in the position of buying a long call, for example, that's out of the money, that has a whole bunch of time value. Because really, if you're good, you're probably going to be right only about 1 in 4 times. And most people aren't even that good. And so you're really going to be, over time, losing quite a bit on those kind of trades. So the other tip is, stay away from trades where you're exposing your account to a whole lot of time value risk. And if you're going to take a flyer, make sure it's a very small percentage of your account, because, most out of the money call options and put options, most of them expire worthless, right? And so it's a good idea, if you're gonna speculate on something that you think is gonna shoot up real quick, just to use even a small percent of risk on your portfolio, like 0.5% or something like that. So another tip is, people get involved in options and they take on these complex strategies requiring a lot of management, but they don't really have the time to commit to managing the trades, right? And so, you see a lot of trades that are management intensive, that require adjustments along the way. And, if you don't have the time to commit, if you can't get in front of the computer a lot, well, you're just asking for trouble, right? Because you can't manage the trade. So if you don't have the time or the inclination to spend a lot of time on complex strategies, don't get involved in them. Do things that are simpler. Do directional trades, or my personal favorite is spread trading. I do a lot of bull call spreads, deep in the money bull call spreads. So the other tip is, keep a trading journal. And in the trading journal, don't just record the mechanical stuff, like the pricing and the size of the position and the kind of contracts you put on, but also make a note of your emotional state on the day that you put these trades on, because you're going to find over time that if you're feeling good or feeling bad, you're going to make judgment mistakes, more so on certain days and other kind of days, because of your emotional state. So it's a good idea to have a journal where you maintain this stuff, and then you can go back over your results and say, when I wasn't in a good mood, or when I was upset, or when I was angry, I didn't do quite as well. Or maybe when you're angry, you do really well. I mean, I don't know, make yourself angry all the time, and then you can be trading to the moon, right? But really, the bottom line is, the tip is, stay in touch with your feelings, learn what kind of feelings generate good returns, what kind of feelings generate bad returns, and do an inventory every day of how you feel. Okay, the next thing I want to talk about is deep in the money call options are a safer way to trade riskier stocks. Like for example, if you're going to trade like a biotech stock, which might be subject to some news event, you can do a deep in the money call option, so you're not exposed. You don't expose as much of your principal to the risk of loss from a news event in the biotech stock, right? Now, mind you, if the biotech stock, goes down, it's a bad news event, you're going to lose a whole lot of money, or I should say a big percentage, but you got to keep that in mind. You can control your risk better. If you own an $80 biotech stock and some bad news event hits and the thing's a $40 stock and you owned it outright, you just lost half your investment. But if you said, hey, I'm just going to do maybe a deep in the money call option and I'm only going to risk maybe $2,000 in this thing of my $100,000 portfolio, then you're doing kind of the safe method, right? So you're controlling your risk that way. Of course, you can control your risk too by buying put options against a long position, like in a biotech stock. But then it's a little bit expensive because those put options are going to also have a lot of premium in them. So the trick I guess, tips and tricks. So maybe a trick I want to talk about is vertical call spreads. And especially, we've talked a lot about these in the past in different videos on this channel. And the thing that I like about deep in the money vertical call spreads is you can make money if the stock goes up, sideways, or even down a little bit. And so they're high probability trades. What you really want to look for in these vertical call spreads, or at least what I'd like to look for, is these stocks that are trending really smoothly, because you can control your risk so well, right? So you have these stocks that are trending really smoothly, and then you're doing these vertical call spreads where you can benefit even if the stock goes down a little bit. So you get these stocks on pullbacks to trend lines, and there's some stocks like Microsoft and Visa which have trended really well over the last few years. And this is a new one that I'm pulling up right here. It's Zendesk, and I've talked about this in a previous video. And Zen it's one of those businesses that's a recurring subscription model. It's a very sticky business, and so the customers they just pay month in, month out, and the stock starts to reflect that, right? It trends really smoothly. There isn't a whole lot of volatility in the stock price because people don't expect surprises in the earnings, because it's rather predictable earnings. So you can do these vertical call spreads where you maybe, like for example, right now the stock is hovering near the 50-day moving average, which is actually a good place right now potentially get involved in a spread trade like this. And you could do like maybe a 75-85 spread or a 70-80 spread. And you can, on an annualized return basis, you're looking at over 100% returns on like a 1 month, 2 month out vertical call spread on that, where you, in this case, you'd maybe buy the 75 and sell the 85 at 1 month out, or buy the 70 and sell the 80. So that's a trick. That's something you can do to make consistent returns over time. You just do that kind of trade, every month. Every time this thing pulls back, you put another one on, and you have a little bucket of these stocks that you look at over time. So then the other thing that's important is you're trading options, and you want to stay in tune with market direction. Right? You don't want to be putting on like a long directional trade when the market's looking toppy, right, short term, or you don't want to put on a short a trade where you benefit if the market goes down when the market's already sold off a lot and is ready to go back up. So in our group in Street Smart Options, we maintain a proprietary list of indicators, of cycle indicators that we watch and follow to pick these bottoms and tops, so that we can in these 3 to 12 week cycles, so that we can better optimize our profit objectives. So, like for example, right now the S&P, it's it might not be obvious from the chart, but it's actually in a good buying range. Or I should say, it's in a low risk entry area. Now, mind you, no timing system is perfect, right? But over time, you keep on applying a consistent timing method, and you're going to outperform the indices by quite a bit, because your timing method is usually right, although it's not always right. And so you stops when you're not right. But if you're consistently right, like four out of 5 times, you're pushing the odds in your favor. And so like right now, for example, is a good time in the market to get involved. And then you got this company called Zen, which is pushing new highs while the market is sold off, so it's showing relative strength. And certainly a deep in the money bull call spread on this kind of stock right now is a very good bet. So you got to stay in tune with the market. You don't want to be putting on trades at the wrong time. When the market's extended, you don't want to be going too long. When the market's sold off a lot, you don't want to be going too short. Counting on things, and counting on the market going down. So, and then the last thing I wanted to talk about was you have to stay ahead of news events in stocks, right? You don't want to be putting on for example, a directional trade ahead of earnings, right? So you want to know when the earnings are going to come out in a stock. And it's simple to find out when earnings are coming out. You can just go to finance.yahoo.com and it'll tell you, when the earnings are coming out on any particular stock. Just type in the stock symbol and you can pull it up. The other thing you want to stay ahead of is like with biotech stocks are PDUFA dates, right? When is the FDA expected to make a judgment on a biotech stock? Now, mind you, biotech stocks have other, I call them exogenous news events. Something might go wrong during a clinical trial before the FDA results, right? And they have to stop the trial because of an adverse health event or something, and that can tank a stock pretty quick. But you have to be, aware of the event risk in a stock and what kind of positions to put on in case of event risk. So that's my little bag of tips and tricks for trading options. Jim, I'm going to put it back to you.
All right, fantastic, Jonathan. So, folks, if you're not a member of our Facebook group, you really should be. It's 100% free. And as Jonathan mentioned, we pass a lot of information over in our Facebook group. So thanks for listening, and have a great day.